So, my fellow holder, Bitcoin just hit $79,000. 5 days ago, on Monday, it was sitting at $63,260. Now, let me ask you something, and actually answer it in your head before you keep watching. Are you happy right now? Are you euphoric? If you are, you should be concerned because you have a problem, and in the next 13 minutes, I'm going to show you exactly what it is and exactly what to do about it. Give me those 13 minutes, and you'll walk away actually unshakable, not because I hyped you up, but because you'll understand exactly why corrections happen. Exactly what wrecks holders who had every reason to succeed, and exactly what separates the people who survive this asset's volatility from the people who become its most quoted cautionary tale. Every fact in this video is sourced, dated, and stated plainly, bear case included, because a 13-minute video that only tells you what you want to hear isn't worth your time. Pillar 1, the problem itself. Here's the problem, stated as directly as I promised you in the first 30 seconds. Not teased, answered. Euphoria and panic are not opposites. They are the exact same physiological reaction. Adrenaline, narrowed attention, an urgent pull toward one specific action right now, just pointed in two different directions, depending on whether the number in front of you is green or red. Here's why that matters for you specifically today, not as an abstract concept. The same emotional wiring making you feel great about this week's move is precisely the wiring that panic sells the next 50% drop. Because neither decision comes from a plan, both come from an urgent feeling demanding immediate action right now. And loss aversion research shows the brain treats a loss as roughly twice as painful as an equivalent gain feels good. The mechanism generating both reactions, urgency overriding a calm decision, is identical either way, which means the version of you feeling great right now and the version of you that panics on the next crash are neurologically running the exact same untrained program. Here's the actual risk hiding inside feeling this good today. Every euphoric high that isn't recognized as a high, just felt and acted on, quietly trains the same undisciplined reflex that shows up later as panic, because you're rehearsing act now, think later, either way. And the market eventually charges you for that habit regardless of which direction triggered it. That's your problem, not the price, not today's move specifically, the untrained reflex sitting underneath both the excitement you feel right now and whatever panic shows up later, and the rest of this video exists to show you exactly how to retrain it. Now, the bear case, because this channel includes one in every single block. Not every excited reaction is dangerous, and treating genuine, reasoned conviction as identical to blind euphoria risks talking yourself out of a legitimately good decision simply because it happens to feel good, which is its own kind of overcorrection worth being honest about. I want to pause here for a second because if you noticed yourself nodding along to that last part, feeling a little too good about today's number, that's actually the moment worth sitting with. Most people have never once written down what they'll actually do the next time this asset does something dramatic, whether that's today's excitement or next month's drop, and they're relying entirely on how they feel in the moment, which is precisely what's cost people real money in every single cycle this asset has gone through. That's the whole reason the Bitcoin Holder Bible exists. It walks through the specific behavioral patterns behind selling too soon, panic selling, and FOMO buying, exactly what you might be feeling the pull toward right now, with a real framework for recognizing which one you're most vulnerable to before the market forces you to find out. It's normally $47, and right now it's a flash sale $27, no coupon needed. The price on the page is the price you pay if you act in the next 24 hours, and it goes back to $47 the moment that window closes, so the link below is worth clicking now rather than after you finish the rest of this. Pillar 2. The feeling you have right now has a documented history. Here's the sourcing up front. This comes from Bitcoin News, Blockworks and TradingView analysis of Bitcoin's full price history, cross-referenced against a documented tally from the site Bitcoin Deaths. Bitcoin has been declared dead 471 separate times by Nobel laureates, bank CEOs, hedge fund managers, and prime ministers, and every single time it was still trading the next morning. Here's why that number matters more today than most days. If you'd put $100 into Bitcoin every single time someone declared it dead, you'd be holding roughly 1,043 Bitcoin right now, worth tens of millions of dollars at today's price. The same asset that's made you feel euphoric this week is the exact asset that's been buried in the headlines dozens of times, and it's still here, which tells you something important about how much weight to put on any single week's emotional reaction, including this one. Here's the actual data on corrections, not just obituaries. Crypto bull markets have averaged 9 corrections per cycle, each dropping roughly 23% and lasting about 2.5 months, and every major cycle has produced a peak-to-trough drawdown between 70 and 85%. Bitcoin fell 87% in 2013 through 2015, 84% in 2017 through 2018, 93% in 2011, and 77% in 2022. which means the euphoria you're feeling today and a 70+% drawdown are both, historically, part of the exact same asset's normal behavior. Here's exactly where we stand today, August 21st, 2026. Bitcoin touched $79,000 earlier today, up nearly 25% from Monday's low of $63,260, and is currently trading near $77,100, up about 22% over that same span, with a market cap above $1.5 trillion. Michael Saylor posted publicly today that the structure would weaken if Bitcoin loses $76,000 and fails to recover quickly, which is a real attributed technical line worth knowing, not a prediction this channel is making. Now, the bear case, because we cover it in every single block on this channel. A near 25% move in 5 days is exactly the kind of euphoric spike that historically precedes a sharp pullback. Not because euphoria causes crashes directly, but because it's the emotional state in which people take on the most risk right before conditions change. Nobody, including this channel, knows whether today's $79,000 is the start of a bigger move, or the emotional peak this exact video is warning you about. Pillar 3, the math of panic selling. Here's the sourcing. This comes from analyst David Ng's 5-year data study and Glassnode's on-chain research. Missing just the 10 best trading days per year completely erases Bitcoin's long-term return premium, turning a 90% average annual gain into a median loss of 25%. Here's why this happens to good, rational people, not fools. More than 3/4 of the best trading days occur during bear markets, meaning the exact days that make holding worthwhile arrive disguised as the scariest days to be holding at all. Loss aversion is the mechanism, the simple, universal tendency to feel a loss far more intensely than an equivalent gain, and it's what drives panic sellers to sell precisely into the recovery they were waiting for. Here's the on-chain proof and the part that connects straight back to today's euphoria. With roughly 20 million Bitcoin in circulation, long-term holders control close to 75% of the supply, and Glassnode describes the sellers at market bottoms specifically as paper hands, people who panic once price drops below certain thresholds. The 75% who hold aren't smarter or luckier than the people who sell. They simply never let the decision get made in a moment of panic. And the flip side of that same discipline is not letting a decision get made in a moment of euphoria either, which is exactly the moment you're in right now. Now, the bear case. Long-term holders keep holding describes past behavior, not a guarantee, and it applies just as much to people who bought today's excitement as it does to people who might sell tomorrow's dip. Pillar 4, institutional conviction. Here's the sourcing. This comes from CryptoHopper's corporate treasury data and BN Crypto's ETF supply analysis. Roughly 200 public companies now hold Bitcoin treasury positions, together controlling more than 1.26 million coins worth close to $80 billion, with Strategy alone holding 843,775 coins, nearly 4% of total supply. Here's the bigger number most people miss. Spot ETFs hold the largest institutional share, about 1.5 million Bitcoin, over 7% of all supply that will ever exist, meaning close to 1 in 5 Bitcoin already sits inside a company treasury, an ETF, or a government wallet, and ETF inflows have been positive for 4 straight days as of today. Now, the bear case, concentrated institutional ownership cuts both ways, since large holders selling in unison can move markets just as forcefully as they anchor them, and today's inflow streak is a snapshot, not a permanent floor. Pillar 5, volatility in context. Here's the sourcing, briefly. Bitcoin's annualized volatility has fallen structurally from over 180% in 2013 to roughly 23% in recent years. And across 2015 through 2025, its annualized volatility averaged about 54% against the S&P 500's 13%. In October of 2023, Bitcoin was actually less volatile than 92 individual S&P 500 stocks. Now, the bear case. A maturing volatility profile is a real trend, not a promise. And a week like this one, up 20% in 5 days, is a live reminder that short-term swings this size still happen regularly, regardless of the long-run average. Pillar 6, returns by holding period. Here's the sourcing, and the caution that has to come with it. Research from Bitcoin Magazine Pro and analyst Andre Dragosh shows no entry year from 2010 through 2022, held 3 years or more, ever produced a negative annualized return, and the worst 5-year holding period in Bitcoin's history still returned a positive 3.6% annualized. Now, the bear case, stated as clearly as the statistic itself. 12 years of one young asset's history is not a guarantee for the next window, and today's market, with ETFs and corporate treasuries now involved, genuinely differs from the retail-driven cycles that produced this exact track record. Pillar 7. Leverage is what actually destroys holders. Here's the sourcing. Crypto derivatives markets forcibly liquidated over $19 billion in leveraged positions on October 10th, 2025, hitting 1.6 million traders in about 24 hours. And research on Bitcoin perpetual futures found forcibly liquidated traders were using 60 times leverage on average. Dropping to 3 to 5 times leverage would have cut liquidation risk dramatically under the same conditions. Here's the mechanic that matters most, especially this week. 10 times leverage means a 10% adverse move costs you everything, while a holder with zero leverage is never forced to sell at all, because liquidation is always a lender's mechanical decision, never the holder's choice, and that's exactly as true on a euphoric green week as it is on a red one. Now, the bear case. Avoiding leverage doesn't stop you from making a genuine unleveraged decision to buy too much right now out of excitement, which is precisely why behavior, not just leverage, is this video's whole subject. Pillar 8. Checking the price makes everything worse. Here's the sourcing. Research on myopic loss aversion found that checking your portfolio quarterly instead of daily cuts, your odds of seeing a moderate 2% or worse loss from 25% down to 12%, and frequent checking is directly linked to more anxiety and more impulsive, emotionally driven trades. Now, the bear case, this isn't permission to ignore your holdings entirely, since real account security still requires periodic attention. The finding is specifically about obsessive, anxiety-driven checking, whether that anxiety comes from fear or, like this week, from excitement. Pillar 9, the sleep at night test. Here's the sourcing. Common professional guidance for crypto allocation sits between 1 and 10% of a total portfolio, with BlackRock's own model portfolios using 1 to 2%, and Fidelity recommending 0 to 5% at a 2% allocation. Even Bitcoin going to 0, the worst possible case, only costs your overall portfolio 2%. Here's the rule every source in this research converges on. Never invest more than you can genuinely afford to lose. Sized specifically so a full loss doesn't threaten your sleep, your bills, or your life. Decided in a calm moment like this one rather than during a week like this one. Now, the bear case. Correct sizing doesn't eliminate volatility. It only makes sure volatility can't destroy you, which is exactly why sizing is a behavioral tool, not a market prediction. Here's everything this video just gave you, compressed into one sentence. Bitcoin has survived every death sentence ever pronounced on it, and every euphoric spike that came before every one of its crashes. And survival only ever protected the holders who avoided leverage, sized their position sanely, stopped checking the price obsessively in either direction, and refused to let a feeling, panic, or euphoria make the decision for them. The Bitcoin Holder Bible exists to make sure that's you, not another name. The next cycle's list of people who bought the top or sold the bottom. It's normally $47, and for the next 24 hours, it's $27, no coupon needed. The price you see is the price you pay. Back to $47 the moment this window closes. The link is right below this video, and the 15 minutes you just spent mean nothing if the next candle, red or green, finds you exactly as unprepared as you were before you watched it. If this made you feel genuinely more prepared, not just hyped up, share it with someone else feeling this same rush today. Subscribe, because we track every one of these moves as this cycle continues, bear case included every time. I'll see you in the next one. This video is for educational and informational purposes only, and does not constitute financial advice. Bitcoin and other digital assets are highly volatile. Past performance does not guarantee future results, and leverage trading carries substantial risk of loss. Always do your own research and consult a licensed financial advisor before making any investment decisions.